I know you've been leery of the month of August in general. Did this morning's early tone do anything to change that?
Yes and no. I think there are some constructive things that happened today that make myself and Mark Newton, our head of technical strategy, think we're actually in a bottoming, possibly for the month of August. You know, the dollar reversed pretty sharply and yields turned down. And as you know, both would be pretty big headwinds for stocks. I mean, as we got into August, it's been a pretty rough 4 days so far. But I think the jobs number was pretty decent. And then I am kind of optimistic that we're going to get a good CPI report next week. So that's kind of a roadmap to seeing stocks do better next week.
Yeah, we've had a lot of chatter today about what CPI is going to bring us. I think you could maybe argue the tone is relatively optimistic given what we think used cars and rent is going to do in the coming weeks.
Yes, that's right. And I think, you know, and I heard your interview this morning with Jan. Used cars and housing are the two of the three biggest contributors to core inflation over the past year. But if it indeed is starting to glide path lower, and, you know, used cars could fall another 30% and housing on the CPI could fall another 8 or 9, that would set up the stage for, you know, 3 or 4 months worth of, you know, negative contribution from those pieces. So I think core could print close to, you know, below 3%, maybe high 2s for several months. And that's why it would look pretty attractive.
Yeah, and you've been pretty vocal and early, I would argue, in arguing that inflation was going to, in your words, fall like a rock, and that was something investors were not necessarily positioned with. But I would imagine you would argue, too, that the sledding gets a little tougher from here.
It does. I mean, the market's up, you know, almost 20% year to date, so less bad news is discounted. I'm still pretty surprised how many of our institutional investor clients lean bearish. You know, in the last 4 days, a lot of them have jumped on, again, to bet against stocks rising. I mean, there is some technical reasons to be a little bearish in August, but I think people are really quick to flip bearish here. That's not a sign of an ebullient market. It's a sign of people kind of getting pulled in, and there's still $5.5 trillion of cash waiting to get pulled in.
Talk to me about what you think yields told us today. We've had some high-profile announcements of short bets on the long end. We got to 4.2 on the 10-year, now 4.06. Is there a sense, do you think, that maybe this trend that we're getting this afternoon can continue?
You know, I think that the logical side would take the side of like the Ackmans and what Jamie said, which is that, you know, long end rates should be rising because we might have higher inflation plus some risk premia and term premia. But that, as much as that's being said, we know that there's a lot of political considerations and the potential for the Fed to cut rates next year, and the fact that rates are so low in the rest of the world that I think that those actually act as anchors to keep rates lower than we think they should be. And Mark Newton, our technical strategist, does think we're actually going to get repelled from here. So if 10-year yields keep falling, I mean, it's actually good for stocks.